Imagine this. A letter from Social Security lands in your mailbox. You rip it open, your eyes scanning for the important numbers, and your heart sinks. The letter says your monthly Medicare premium is jumping, and not by a little. We're talking hundreds of dollars. It feels like a penalty, a punishment for a lifetime of diligent saving. You've seen the scary headlines and YouTube videos warning you about this exact moment, the dreaded IRMA surcharge. But what if they're all wrong? What if this penalty is just a financial head fake, a distraction from what really matters? I'm going to show you the real numbers behind these surcharges and explain why, for most people, the fear is totally overblown. More importantly, I'll show you how a simple 5-minute fix can potentially wipe it out completely for many new retirees. Let's be real, the fear comes from a genuine place. The income-related monthly adjustment amount, or IRMA, is a surcharge that higher income folks pay on top of their Medicare Part B and Part D premiums. The government's logic is pretty simple. If you have more income in retirement, you can afford to shoulder a bit more of your healthcare costs. Here's the part that trips everyone up. IRMA isn't based on what you're earning today, it's based on your income from 2 years ago. This is the infamous 2-year look back. So the premiums you'll pay in 2026 are decided by the income on your 2024 tax return. This is precisely why so many people get blindsided. They retire, their income takes a nosedive, but 2 years later, they get a massive Medicare bill based on their old higher salary. It feels completely unfair, and the numbers can definitely look intimidating. For 2026, the standard Part B premium is projected to be around $202.90 per month. But if your 2024 income was above certain lines, you start paying more. Those lines are based on your modified adjusted gross income MAGI, which includes not just salary, but also things like traditional IRA withdrawals, capital gains, and even tax-exempt interest. For 2026, the first surcharge kicks in for individuals with a 2024 MAGI over $109,000 and for couples over $218,000. Once you cross that line, the surcharges start stacking up. Let's look at the projected tiers for 2026. A couple filing jointly with a MAGI between $218,000 and $274,000 would see their monthly Part B premium jump to about $284.10 each. On top of that, they'd get a Part D surcharge of $14.50 each. As your income climbs, the surcharges get steeper. The highest tier for joint filers with income over $750,000 could face a total Part B premium of $689.90 per person per month. When you see your premium potentially doubling or tripling, it's easy to see why panic sets in. But here's what those scary charts and fear-mongering headlines conveniently leave out. They're missing the most important part of the equation, the income that triggered the surcharge in the first place. This is the financial head fake. Freaking out about the surcharge is like staring at the price of a speeding ticket without acknowledging the powerful engine that got you there so fast. Paying IRMA isn't a penalty for failure, it's a consequence of financial success. You only pay this if you've had a high income year. Maybe it was your last year of high earnings, the sale of a business, a big Roth conversion, or a huge capital gain from selling stock or real estate. In other words, you pay IRMA because you made money. Let's put it in perspective. Say you and your spouse are retired and usually have an income of $200,000, but in 2024, you sold a rental property and pocketed a one-time capital gain of $50,000. That pushes your MAGI for the year to $250,000. Based on the 2026 brackets, this bumps you into the first IRMA tier. Each of you will now pay an extra Part B surcharge of about $81.20 a month. plus that small Part D surcharge. Annually, that's roughly $2,000 in extra premiums for the household. Does paying an extra $2,000 feel good? Of course not. But if you're paying it because you made an extra $50,000, the surcharge is just 4% of the additional income you brought in. It's not a penalty. It's a progressive cost tied to a profitable move. In the grand scheme of your finances, it's a manageable expense. The real danger isn't the surcharge itself. The real danger is making bad financial decisions because you're terrified of triggering it. This brings us to the most important part, what you can actually do about it. The goal isn't to live in fear, it's to be empowered with a plan. And the great news is there are powerful strategies you can use. First, let's talk about the quick fix, the most important tool for anyone whose income just dropped. It's called Form SSA-44. Think of this form as your direct line to the Social Security Administration to say, hey, you're using old information. My financial life has changed. You can file Form SSA-44 if you've had a qualifying life-changing event. The most common one by far is work stoppage, aka retirement. Other events include things like marriage, divorce, or the death of a spouse. When you file this form, you're asking Social Security to recalculate your premium using your current lower income instead of your MAGI from 2 years ago. So for that person who retired in 2025 and got a scary 2026 premium bill based on their 2024 salary, this form is the answer. You fill it out, provide proof of your retirement, like a letter from your old boss, and estimate your new lower income. If your appeal is approved, your premiums get adjusted and you might even get a credit for any extra you've already paid. This isn't some secret loophole. It's the standard process and it works for thousands of retirees every year. Now, for those of you still a few years from retirement, the name of the game is proactive planning. The goal is to manage your MAGI in the years before you hit Medicare. You've got several power tools in your belt. First up, strategic Roth conversions. Withdrawals from Roth IRAs and Roth 401ks in retirement are tax-free, and most importantly, don't count toward your MAGI for IRMA. The strategy is to convert money from traditional pre-tax accounts into a Roth before you enroll in Medicare, especially in your lower income years. Yes, you pay tax on the conversion now, but you're buying yourself future tax-free income that makes managing IRMA way easier. Second, manage your investment income. If you have a big portfolio and a regular brokerage account, be smart about when you sell. Instead of realizing a huge capital gain all in one year, consider spreading the sales over several years to stay under a threshold. Third, if you're over 70 and a half and feel generous, use qualified charitable distributions. A QCD lets you send money straight from your traditional IRA to a charity. That money doesn't get included in your MAGI and can even satisfy your required minimum distribution, RMD. It's an amazing way to support causes you love while lowering your income for IRMA. Finally, don't sleep on health savings accounts, HSAs. If you have one, withdrawals for qualified medical expenses, which includes paying Medicare premiums, are completely tax-free and have zero impact on your MAGI. This all circles back to our main point. Please stop letting the IRMA tail wag the financial dog. Your primary goal in retirement isn't to dodge a surcharge that's a tiny fraction of your income. Your goal is to maximize your after-tax wealth and create an income plan that lasts a lifetime. I've seen this IRMA phobia lead to some truly baffling decisions. For instance, a client was terrified to sell a highly concentrated, risky stock because the capital gain would have pushed them into an IRMA bracket for 1 year. The total surcharge would have been about $3,000. They waited, 6 months later, the market took a dive. And that one stock lost over $40,000 in value. They avoided a $3,000 surcharge, but cost themselves more than 10 times that amount. That is the definition of a financial head fake. Focusing only on IRMA can blind you to the big picture. It might stop you from doing a Roth conversion that could save you tens of thousands in taxes over your lifetime. It might prevent you from prudently rebalancing your portfolio. It might even cause you to put off taking income you need, creating a much bigger tax and RMD headache down the road. So is IRMA real? Yes. Does it cost more for high income retirees? Absolutely. But is it a penalty to be feared or a disaster that will ruin your retirement? Not even close. Think of it as just another variable to manage, not a monster under the bed. Understand the 2-year look back. Know that if your income drops because you retired, Form SSA-44 is your best friend. And if you're still planning, use smart strategies like Roth conversions and QCDs to manage your income for the long haul. Acknowledge IRMA, plan for it, and then put it in the proper place as one small piece of your complete financial puzzle. Don't let the fear of this one line item control your entire retirement strategy. If you're ready to stop worrying and start building a retirement plan that sees the whole picture, book a free complimentary call with me at the link below. See you on the next video.